The AI bubble is popping, which will make smart investors rich. Okay, guys. I don't really want to react to this, but here we go.
OpenAI CEO Sam Altman just warned everyone that we're in an AI bubble. A recent MIT report showed that 95% of all AI projects at
Eh, okay, we're 8 seconds in, and already this guy is just like coloring his bias with these reports. Hopefully, he actually read the full Sam Altman quote, because Sam Altman was basically implying that all the other AI companies are in a bubble, and they are not.
companies are
And this study was just freaking pathetic. This is written by a bunch of like bachelor students who suck. I mean, it's freaking obviously not true. For anyone who's read any of the reports from companies or listened to earnings reports or anything, like, okay.
failing, and top AI companies like Palantir are down by 20% this
The company is up massively. It's one of the best performing stocks on the market right now. You think it being down 20%, having a normal retracement? Hello, down 20%. Hello, do you see this stock? Hello, does this look like AI is failing? The company has some of the most crazy revenue growth. Okay, there's a reason why everyone's buying this. Is it overvalued? Yes, but it's up 3,000%, bro. Who gives a shit about a 20% retracement? We're 14 seconds in. I gotta chill.
week alone. So in this video, I want to answer 3 simple questions. Are we in an AI bubble? How bad can things really get? And what can we do to come out on top? Your time is
We are in an AI bubble. We will eventually have a crash and pretty much everything will collapse. What was the last question?
in an AI bubble. How bad can things really get? And what can we do to come out on top?
You can short the market. You can realize that we're in a bubble and figure out how to not be the dumbest guy at the table and pay attention to things like social signals to get out early. And you can also, smart investors would have recognized the bubble probably pretty quick and they would have bought it. That's how you get rich, is by buying the bubbles. Okay? Everyone who's made a shit ton of money in the market knows this.
Your time is valuable, so let's get right into it. Sam Altman recently told reporters that investors are too excited about AI, comparing today's market to the dot-com bubble of 2000, where the Nasdaq collapsed by around 80% after overhyped internet companies failed to generate revenues, let alone profits. And Sam Altman isn't alone. Last week,
And he said that is such a bad faith interpretation of what Sam Altman said. It is such an unbelievably bad faith. How many views does this have? 6,000 likes, 125,000 views. I feel sorry for all these people. I feel sorry for this guy because that's just such a bad faith interpretation. And he probably isn't even doing it intentionally. He just hasn't learned how to control his bias.
University of Michigan business professor Eric Gordon said that investors will suffer far more from this AI boom than the dot-com crash, warning that AI startups like CoreWeave will become the poster child for the AI bubble and make even more investors suffer even more pain than companies like Pets.com did during the dot-com crash. And earlier,
We gotta speed this up because this guy talks really slow. Whoops. This is rough.
even more investors suffer even more pain than companies like Pets.com did during the dot-com crash. And earlier this year, billionaire investor Ray Dalio warned everyone that investors are confusing AI being a great technology with it being a great investment. And it's not just investors. MIT's
Right, because the dot-com bubble, the market crashed even though it was still changing the world, right? Internet obviously became a big thing, but market still crashed, right?
NANDA Initiative, which is a group focused on agentic AI research at MIT, published a new report saying that 95% of companies launching AI pilot programs are seeing little to no results, but some of the biggest warnings are targeting
The results that most of these companies are seeing when they incorporate AI is in productivity. It's not in actual revenue acceleration, right? Because that's what AI does. AI isn't going to help you make a better chair necessarily because it's trained off what humans know, and it's not like a generative intelligence that will create new ideas. It kind of does, but only on like a very small scale. But what it will do is help with the efficiency of the company, and it will increase productivity, which isn't the same as like a rapid revenue acceleration. Like everyone who's paying attention, who knows what the fuck they're talking about, knows this. It's, I don't know, it's very common knowledge.
Specific companies. For example, Citron Research recently published a short report saying that if Palantir had the same price to sales ratio as OpenAI, then it would be trading at around $40 per share, which is more than 70% lower than its current share price. And since my entire channel focuses on the stocks at the center of the AI revolution, I thought that I'd add some context to all of these warnings. I respect your time, so here's the bottom line up front. I agree that parts of the stock market are in a bubble, but I don't think it's as widespread or as dangerous as the mainstream media is making it out to be. So if you just wanted the short answer, there you have it. But I don't invest my money.
No, I mean, pretty much everything's in a bubble. He's wrong. I mean, housing market's in a bubble. Stocks generally are in a bubble pretty much across the board. Prices are too high. Valuations higher than they were at the dot-com bubble. It is worse. It is as bad as he implied at the beginning of the video. What matters is, are you actually benefiting from that? Are you actually recognizing that we're in a late stage empire where the government is printing unbelievable amounts of money and not slowing down whatsoever? The market's at all-time highs. We're talking about rate cuts. If you're not in this market and you are sitting out because you're like, oh, it's a bubble, you are fucking up royally. Okay. The reason people on Wall Street are still buying this market is because they're looking at the prices of things go up around them, and they're realizing if I don't keep up with that pace, then I'm fucked. And that is way scarier than a might happen crash sometime in the future. And they know they're not the dumbest guys at the table, and they'll get out. Some of them will actually get out, because usually what happens with these bubbles is they keep going until people stop thinking it's a bubble, until people think, no, this might be legit. That's when the rug gets pulled, and it's usually from some sort of event. So the real fuck up is not getting in and understanding that the most efficient thing you can do is actually what all these degenerates are doing, which is snagging up a shit ton of leverage and going long into the bubble and buying it up. And Stanley Druckenmiller talked about this. It's like one of his best wisdoms. If I see a bubble, I buy it as fast as possible.
Money based on feelings. I invest based on data. So the rest of this video uses data to find out which stocks are actually in a bubble, how big that bubble could be, and for how long. Let's start with which stocks are actually in a bubble. In my opinion, comparing today to the dot-com bubble is a big mistake. Most dot-com companies like Pets.com had little to no revenue, zero profits, and burned money like crazy on overly optimistic business plans. It was also cheap and easy to launch a dot-com company. All you really needed was a website and a dream. On top of that, the biggest problem back in 2000 was a lack of infrastructure. Consumers weren't really shopping online yet, and broadband internet was limited, resulting in way more supply than demand for most dot-com businesses. Compare that to today, where the top AI companies are Nvidia, Google, Microsoft, Amazon, Meta Platforms, and TSMC, all of which have huge revenues and high operating margins. Also, it takes millions, if not billions of dollars worth of infrastructure to compete in the AI market, and consumers can already use AI because it's being baked into almost every app and service on the planet. As a result, there's way more demand for AI software and hardware than there is supply. That's why I think we should compare today's AI market to the rise of the mobile internet instead, since companies and consumers were already online as every website, every piece of software, and every service transitioned to mobile applications, just like what's happening today with AI. Here's a case study from Morgan Stanley Research that looks at how different kinds of stocks performed during the rise of the mobile internet, and it breaks these stocks out into three groups: semiconductors, infrastructure, and software and services. The big idea here is that today's AI companies can be categorized almost the same way as foundational AI companies, AI infrastructure companies, or companies focused on AI services and applications. And looking at things this way, I don't think that all three groups of AI stocks are in a bubble. Here's why. New technologies are always built on top of everything that came before. So while high margin software and service stocks usually have the best long-term performance, they're also the last group of stocks to rise. rise, since they need reliable infrastructure to build on top of. AI infrastructure includes data centers, as well as edge devices like smartphones, laptops, and desktops, and eventually AI-specific platforms like self-driving cars, physical robots, and digital agents. But before that AI infrastructure can reach mass market adoption, semiconductor companies need to build the chips that power it. That's why I don't think that semiconductor companies are in a bubble at all. In fact, they've been reporting strong revenue growth, high operating margins, and sales that are limited by supply, not demand. The same is true for hyperscalers like Microsoft, Google, and Amazon, all of which
It's in a bubble because people don't know how much compute they actually need to run these things. So there's gonna be some sort of efficiency equation that's developed through this, and we're in that process of discovery. And so some of these companies might be way overspending from what they actually need, but they don't know because this is a new that we're in this age of discovery. So it's still a bubble. It's definitely a bubble. But it could go a whole lot higher.
reported roughly 30% data center revenue growth and increasing margins, even though they've each been investing close to $100
You
billion.
gotta also think that these AI companies exist in like normal cyclical patterns, right? New chip comes out, price appreciation, big retracement. New chip comes out, price appreciation as people have to upgrade, right? It's just a business cycle. And when the initial hype is done and the innovation kind of slows or reaches like a natural growth curve, when we hit some sort of block, probably before we reach generative AI, that's probably when you'll see a massive rug. And that rug probably won't come from actual AI. Like one of the things that would happen during the dot-com bubble is as soon as the government kind of started trying to lower the deficit and stop printing so much money, that's when the real rug got pulled, right? We'll probably see something similar because what's driving all the excess money that people have to dump into the market is all from fiscal policy and government spending
Into new data centers to meet so much demand, and that's this year alone. I think the real bubble is in this third group of companies, AI software and services, particularly companies like Palantir and CrowdStrike. Here's a table comparing the price and trailing 12-month sales for today's top AI companies, sorted by their price-to-sales ratio. Lower price-to-sales ratios are obviously better, but high revenue growth can justify a higher ratio today, since it implies a lower price-to-sales ratio in the near future. For example, NVIDIA currently has a price-to-sales ratio approaching 30, but their annual revenues grew by over 80% year over year. Compare that to CrowdStrike and Palantir, which have 40 to 50 times less revenue and are growing less than half as fast. This is where
That's not true. Palantir's got an insane growth rate for its retail sector. So I don't know where he pulled this from, but Palantir has got some amazing metrics. And what happens during these FOMO time periods is people are willing to overpay for things that are high quality.
the real AI bubble is, in my opinion. Don't get me wrong here. I'm a big believer in the next generation of AI platforms like Palantir and CrowdStrike, and I think they'll perform great over the long term, just like the Morgan Stanley case study is suggesting. But there's no doubt that these kinds of companies are currently overvalued. On top of that, many of the companies building next generation AI applications are not publicly traded. Think about the 90s and early 2000s. Companies like Amazon and Google went public very early in their growth cycle, but today they're waiting an average of 10 years or longer to go public. That means investors like us can miss out on most of the returns from the next Amazon, the next Google, the next Nvidia. That's where Fundrise comes in, the sponsor of this video. Their venture capital product lets you invest in some of the best tech companies before they go public. Venture capital is usually only for the ultra wealthy, but the best late stage companies before the website and a dream.
When you invest in those private companies, the money's also locked up for 10 years. So good luck.
Current AI bubble is concentrated around specific AI software companies like CrowdStrike and Palantir, but that doesn't mean they're bad investments today. Everyone talks about the stock market dropping by 80% after the dot-com crash, but almost no one talks about what happened after. If you bought $10,000 worth of Microsoft stock at the absolute peak of the dot-com bubble in 2000, you'd have over $85,000 today. That's a 9% compound annual growth rate, but for 25 years straight, which more than doubled the performance of the S&P 500 over the same time frame, even though you bought Microsoft stock at the absolute top of the biggest bubble in stock market history. And you would have done much better if you dollar cost averaged into the stock instead of buying at the top. Like I point out in every single video, valuation matters, but the quality of the underlying business matters more over time. Said another way, I'd rather buy a great company at a bad.
The likelihood that the pop in AI is caused by some sort of geopolitical or major macro event, maybe the dollar finally self-destructs and then we transition to a crypto world, it's like way too uncertain to tell. But it probably won't come. The crash won't come from, will have to come from some sort of outside event or a rugging of fiscal irresponsibility.
price than a bad company at a great price. And the best way to find great companies is understanding the science behind the stocks, which is just my way of saying how the high-tech company behind the ticker symbol actually makes its money. But let's say you think I'm full of shit. Obviously, no one in the world thinks that, but let's say you disagree with everything I've said so far. Let's look at one more important piece of data to see what could happen if we were actually in a big bubble. This is a chart of every bull and bear market since 1956. The y-axis is percentage returns, the x-axis is time, and every recession is highlighted. A bear market happens when stocks crash by 20% or more from a peak, and a bull market begins once the market bottoms. Here are some interesting facts that long-term investors need to understand. First, bull markets last much longer than bear markets. The average bear market lasts about 1 year from peak to bottom, and declines by about 36% on average. The average recovery takes about 2 years to make a new all-time high from that bottom. And that sounds like a long time, but remember, it's only 2.5 years if you bought at the exact top right before the market crashed. That's also why it's so important to be patient and dollar cost average in over time. Even if you miss the exact bottom, there's a huge 2.5-year window on the other side. And speaking of the other side, the average bull market lasts over 6 years and returns well over 200% over that time frame. Even if you compare the extremes, the worst bear markets were the global financial crisis and the dot-com crash, which lasted about 2 years each and had drawdowns of 50 to 60% for the S&P 500. But the biggest bull market lasted over 12 years and went up almost 600% over that time frame. So there's a massive difference between bull and bear markets. Let's look at market corrections next, which is where the market drops between 10 and 20%. So these are separate from bear markets altogether. On average, the market falls by 14% during a correction, reaches the bottom in 5 months, and takes just 4 months to recover. The S&P 500 has had around 22 corrections since 1956, which works out to about once every 3 years on average. And just to be
I was too unfair to this guy. This video is pretty good. He's covering these things. He basically, yeah, if you could buy every single top, right, with the absolute top of every single market cycle and still make a killing in the markets, which is, for people who are too scared to even invest. We're not even talking about trading at this point, right? This is just about investing. Like, you are royally screwing up your life and the quality of life you can have later on. Your future self, you're fucking your future self royally.
Thorough, here's the number of 10% pullbacks the S&P 500 saw each year from 1980 through 2023. Some years the market can go straight up without so much as a dip, while others we can see anywhere from 4, 5, or even 8 separate 10% drops. Overall, the stock market sees about 1.2 pullbacks each year, which is about once every 10 months on average. But no matter how many pullbacks or corrections or how bad of a bear market we've seen, the stock market has always recovered and gone on to make new all-time highs. And now that we have all that context, we can answer the big questions from the start of this video. Are AI stocks in a bubble, and what can we do about it? And if you feel I've earned it, consider hitting the like button and subscribing to the channel. That really helps me out, and it lets me know to make more content like this. Thanks, and with that out of the way, let's answer those questions. First, I don't think we're in an overall AI bubble. Semiconductor companies like Nvidia and TSMC have been reporting serious revenue growth and high operating margins, which is fundamentally different from what we saw during the dot-com bubble. The same is true for AI infrastructure companies like Amazon, Microsoft.
And so he didn't make this mistake at the beginning of the video, but he is making this mistake now, where these companies are changing the world. They do have real businesses, and it's still a bubble. The valuations are still too high.
And Google, even though they've poured hundreds of billions of dollars into data centers this year alone. And I expect that growth to continue for many quarters to come, which is why I cover chip design and data center companies more than any other kind of stock. That said, I do think that AI software stocks like Palantir and CrowdStrike are currently overvalued, especially for how early we are in the AI revolution.
They're not as overvalued as companies like Adobe that are basically already dinosaurs, but the market hasn't caught on to how useless that company is because, they have a few AI tools. It's like, okay, but they're priced too expensive, right? And that might be an issue Palantir comes up in the future, because if AI generally gets smart enough to incorporate itself into programs or to write its own software on demand, or if a lot of these companies have the ability to have AI write all the software in-house for them, just think about how many companies are in massive danger because of that. Like Microsoft has built their entire empire off of a monopoly in corporate enterprise software. If all those companies can write that software using AI in-house on their own for next to nothing, obviously this is the issue when we look at dumb things like that MIT research study, which wasn't, there's a lot of good minds at MIT, but that study was not written by them. Like, I don't know, like MIT janitors or something. It was a really shit study with really like generic numbers thrown around. Probably one of the worst. And it has that MIT label, so everyone acted like it mattered. Did not matter. Was total shit. But that's what really is at risk here. And that period of transition can be extremely rough for the market. And it could be one of those weird prolonged bear markets.
Companies are trading at very high price to sales ratios, and they're growing slower than our first two groups of stocks. That doesn't make these companies bad long-term investments. It just means that we shouldn't be investing in them as much at these prices over AI chip and data center companies. Second, we assumed that I was wrong about everything, so we looked at historic data to see how bad things could get if we are actually in a bubble. It turns out that bull markets last around 6 times longer than bear markets and return around 6 times more than bear markets lose. We also saw that stock market corrections are way less scary than they sound. They only happen once every 3 years outside of bear markets, they only drop around 14% on average, and they usually recover in under 6 months. And if you put these two answers together, you can make a plan that's right for you. I'm not making any big changes to my overall portfolio. My current plan is to just dollar cost average in a little slower, keep a little more cash on the side, and move a little more money into those first two groups of companies. Big safe semiconductor companies like Nvidia, Broadcom, and TSMC, as well as the hyperscalers, which means Google, Microsoft, and Amazon. Don't overcomplicate it. And if you want to see what other stocks I'm buying in this market, check out this video next. Either way, thanks for watching, and until next time, this is ticker symbol U. My name is Alex.
That wasn't terrible. You could do a little bit more research and think about more of like the future implications, but ticker symbol U. Not a bad video. Just he did phrase things in a certain way, I guess, to generate interest and to generate that fear to get people to watch the beginning. I don't know. Shit like this, man, I feel like it's brain rot because it's not really that insightful at all. But I don't know, I'm just being a hater right now. It wasn't that bad. Follow me for more reactions as I'm like literally falling asleep.